Hello everybody, welcome. I'm going to walk you through a quick video that's going to focus on financing listing of equity and predominantly focused on the Canadian markets here. So, we're going to think about when firms need to raise capital. They may have investable projects, they have profitable opportunities on, they may need capital. And one of those ways to raise capital we see a lot of times is through the equity markets and the public equity markets, trying to raise that capital so they can use that capital to go out and maybe refinance their business or to invest in these profitable projects. So we're going to walk a little bit through some of the basics of the financing and listing of equity here in Canada. So the first slide here, financing, or sometimes we commonly refer to as underwriting in finance, is really here. You're going to raise some sort of capital, and this can either be through, like I said here, this can either be done through the debt market or the equity market in Canada. And we're going to predominantly focus on the equity market here, and it can either be in the public eye or privately, depending on if the firm's already public or if the firm's private. There's different ways that they can raise that type of capital that they need. Now, we typically refer, if we're going to focus on equity, right, when we focus on an equity style, we usually refer to these either as an IPO or a secondary offering, okay, or sometimes they refer to as seasoned offerings or SEOs, right? We can sometimes put SEO associated with these guys, seasoned equity offering or secondary equity offering. But here, IPO's initial public offering, a firm's going to go through and raise capital and go from a private firm to a public firm and raise that capital. That is referred to as an IPO. So the first time they're going to go public, these are usually very heavily publicized. You hear about these things in the media, in the news. Some very popular ones we've seen in the last decade, like Facebook or Google. All these types of firms had to transfer from being a private firm into a public firm, and there's different reasons why firms want to do that, but we're not going to get into some of those reasons. We're just going to kind of walk through, what is the role, what is the methods of acquiring this capital. So here, in order for, you have a public firm or a private firm and they want to raise capital, usually these firms aren't in the business of, being able to finance their operations. They're usually in the business, like I said, of tech, software, construction. They may not have the resources behind them and the competency within their department to really go out and raise capital and raise this type of money. And this is where investment dealers, we refer to them in Canada as investment dealers, or investment banks come in. Okay, and really help out firms trying to raise the capital that they need for their projects. And so what is the role of the investment dealer? Here, the role of the investment dealer is really, giving advice to this firm about what type of securities they should offer, right? So here, the type of securities, this can be equity securities or debt securities. And from previous slides, that there's a variety of different equity types that we could potentially offer, lots of different types of debt we could offer, and different maturity ranges, etc. So this is, of utmost importance to decipher which one of these two sides here, should the firm use to raise this capital. And the other one here is the size of the issue. Usually, for a firm, they know that they need X amount of capital going forward. But the investment dealer, they're going to know how receptive the market may be to different issue sizes, right? Maybe the market's not very receptive right now of a large equity issuance or a large debt issuance. They're going to have to kind of give some advice to the firm trying to raise capital about, hey, this is the approximate size that the market's willing to take on right now. And that also ties into this third bullet point here, is the timing of the issue. Okay, so, again, the issuing firm trying to raise capital, they may not have their fingers on the pulse of the market, right? And the underwriter or these investment banks or investment dealers, they know exactly how receptive the market is at this point in time in terms of debt, equity, and they're going to be able to give advice about, maybe this year is a good year. Maybe we should wait till next quarter to go out and maybe obtain you a better deal in the market. So these guys are really going to give great advice here in terms of timing. whether they should be a public placement or a public offering, or they may have a client that they may already know that would be receptive of taking on some sort of finance agreement with the issuing firm itself. And so if that's the case, a private placement may be less costly, may be less burdensome to the issuing firm to go down that route if the underwriter knows there's a potentially investor out there willing to take on a big portion of the financing that the issuing firm has. This guy here developing the prospectus, and we're going to look at some prospectuses here in the next couple minutes. This is a big document. Lots of work goes in it. We're going to talk about this more in the next slide. But here the prospectus is really trying to provide investors with all the information that they need to make a decision on whether they should invest in this company or whether they should not invest in this company, and make some sort of a knowledgeable decision about that. And this is a long document. We're going to look at a couple of different examples of these documents here in a second. Setting the offering price, again, like I said, these investment dealers, investment banks, they know how the market is going to be receptive of this. They may understand it and put some sort of valuation, right? This is a valuation on the firm, right? So, many firms think sometimes they're worth more than what they really are. The underwriter is going to have to come in there and put some sort of valuation on that firm, and the different methods that they can go through to do that. But this is going to be a huge portion, because you don't want to overvalue, you don't want to undervalue. A lot of the times in the IPO world, we see that most firms usually have this first day run up, right? And so we refer to as as underpricing, and there's lots of research that focuses on how IPOs have been historically underpriced, and this can range depending on the year by anywhere by 2, 3, 4, 5%, all the way up to 50% on average if we go back sometimes in the late 90s, right? And so obviously the firm wants to price their security in a way that they'll be able to receive as much money as they can when they do list their securities. They want to leave money on the table that they may have had. So this is a huge portion of what the underwriter should have, what role they should have. And a lot of time goes into trying to put some sort of proper valuation on that firm, especially if the firm's going from a private firm to a public firm. Again, there's maybe not that much market data out there on them to really provide them with a real accurate figure of that. And the last one here is market support. Okay, so once this issue has been pushed out into the public market, the underwriter, the investment dealer, the investment bank, may have a duty to provide some sort of market support for this asset or for this now new IPO that has hit the market. And typically we see this as like aftermarket stabilization. It's usually referred to as in prospectus aftermarket stabilization. And this is really one of the most common one is what is referred to as over allotment option. We're going to look at that, an example of that in one of these prospectuses coming up. Okay, so the next slide here is going to be focused on the prospectus. All right, so the prospectus. Well, what is a prospectus? Hey, this is going to be a document that provides investors within the province, if we're here in Canada, with a minimum amount of information that they need to make some sort of decision on whether they want to invest in this firm or not. And so, what details we have in here. The history of the firm, the operations of the firm, the management of the firm, the financial and risk statements of the firm. All these different things are going to be outlined in the prospectus in great detail. Usually we see prospectuses, anywhere between 200 all the way to 500 pages long, right? These documents sometimes, and really lengthy in detail about pretty much anything that you really need to know about the company in order for you to make some sort of informed decision. And the basic principle behind, these prospectuses is full, true, and plain disclosure, right? Full, true, and plain disclosure of all the material facts related to the securities offered. So let's look at two different types of prospectuses. The first one, the preliminary prospectus. So initially, firm's going to file this preliminary prospectus along, in conjunction with their investment banks they're working with, or investment dealers they're working with. And here they submit this to the security regulators. Within there, they have 90 days from the submittal of this preliminary prospectus to them submitting their final prospectus. And this 90-day period is referred to as the waiting period. And most commonly, this preliminary prospectus is called a red herring prospectus. And why that is usually there's red ink denoted on the front page to let people know that this is a preliminary prospectus. There may be changes, amendments to this prospectus on going forward basis. Key thing here is that this preliminary prospectus does not have the final market price within there. That's not going to come until the final prospectus is filed. And when that final prospectus is filed, this is when all the details of the offering price and all the other details that that need to be disclosed in terms of offering price, number of shares, etc., are going to be now provided in that. And we can find these here in Canada on a website called Cedar. Okay, and we're going to go onto this website here now. And we're going to look at a prospectus. Maybe we'll walk through some of the different components of that. This might give you a much better idea of what a prospectus is and how companies raise capital. So if we discard this and we come now to CEDAR, this is the website CEDAR, and this is really where you can get pretty much all the information you would want on a company in terms of their public disclosure documents. And this can be financial statements, this can be prospectuses, this can be takeover bid documents, this can be lots of different things. You can go on to CEDAR, to cedar.com, and we'll go into the English portion of this website. If you get on here, we can search the database, and we're going to search for companies, and within here we can do lots of different things, right? So we can search for a company. Popular IPO that happened here in Canada in the recent months is Roots. Okay, so the clothing company, and here you can see that all the different reports that we can look at and get, potentially annual reports, financial statements, issuer bids, other news releases, etc. Lots of different reports within there. But here we just want to look at the prospectus because that's what we're focused on in this discussion. So we have Roots, we have the prospectus, and here the filing dates, we can change that. Roots happened just this past fall. So this captures the dates. We don't have to change that. If we hit search, we're going to see that here are some of the documentations we see for Roots. Okay, and so you see they have their preliminary prospectus. Hang on. Apologize, another phone call in another video, and my wife always calls me and always asks me to bring home extra milk. But anyways, back to this documentation of these prospectuses. You can see here that we have long form, short form, amendments to these different prospectuses. So if we open up one of these long forms, and I've already done this just to make things a little bit quicker, if we open up one of these long forms of Roots, right, here's the long form prospectus of Roots. And so you're going to see here, this prospectus is dated October 18th, 2017. As we go through this prospectus, we can see that this is an IPO, and this is an IPO by way of secondary offering. What that means is that the IPO, this initial offering to the public, is actually shares that are already being sold or held by current owners, and they're just going to liquidate some of their existing shares that they own. And so there's not going to be any new shares issued here. These are insiders or existing shareholders that are just going to liquidate their positions within there. So there's actually going to be no new money actually generated for this Roots offering. So if we walk through this prospectus here a little bit, here you can see Roots Corporation. They're raising just over $200 million in this prospectus, or selling $200 million of shares, and they're selling just shy of 17 million shares. And so you can see here's the offering. Within this offering, they're going to document, as we just talked about this secondary offering, we can see that this is being sold by these two corporates. So the Searchlight Capital and Searchlight TMK. These firms are the firms that are now selling shareholders of Roots. And if we go through here, this is going to document lots of other different things and outlines who Roots is, they're going to go through some glossy pages here first to kind of outline what Roots is. Everybody knows, at least in Canada, that Roots is a retailer of clothing. If we get down to this page, this is really where they start to kind of get into a little bit of the details of the offering. So as we can see here, this offering, the selling price of this offering is $12 per share. So that's the price to the public. The underwriter is going to receive 66 cents in fees. So the net proceeds going back to the selling shareholders is, as in this case, would be $12 minus 66 cents, which means going back to the selling shareholders, they're getting approximately $11.34 per share that they're selling. Now, this 66 cents underwriter fee times by these close to 17 million shares, this is going to give underwriters close to $11 million in fees. Now, these fees aren't just profit that the underwriter is putting in their pocket. You know, obviously with these fees here, this is going to be, you know, there's expenses, you know, that corresponds to the underwriter's ability to sell these shares, to document the prospectus, to walk through these. They have obviously costs associated with it. So this is not all profit, but this is a healthy revenue stream for these investment dealers and underwriters. So you can see here the offering price has been determined by the selling shareholder, so by Roots and these inside owners that are selling, and also by TD, Credit Suisse, and BMO. And so in this case, these three firms here, TD, Credit Suisse, and BMO, these are the principal underwriters of this issue. Okay, and so they've come together as a collective unit, and they're going to be the main underwriters of this issue. If we go further down here into this document, we can go down into the table of contents, and you can see within the table of contents, this is going to give you a bunch of different information if you want to understand, you know, about Roots, about what their business is, about who the principal shareholders are, about you know, executives, about their financial statements. You can obviously go through this document and get a bunch of different information. Now, a good way to start, if this is a first prospectus you're looking at, if you can scroll down, there's usually a summary page of the terms of the prospectus. And so here's a prospectus summary, kind of tells you what their story is, the history of Roots, and talk about some of their main financials, about their competitive strengths, etc. You know, what their growth strategy is, what their kind of you know, capital structure is, and what their outlook is in terms of Roots in general. And then they're going to have a summary offering. And here, this is really going to tell you a lot of information about the actual offering. So here we can see that we have the selling shareholders that we saw earlier. Here's the offering price, the offering size that we saw earlier, the over-allotment option that we're going to talk about here in a second, along with all these other different characteristics of the offering, right? Whether that's the dividend policy, lockup arrangements, other risk factors within the offering. We can go through this and really, you know, extract a lot of different information that we may need to, you know, determine whether, you know, this is a good offering, what the risks associated. Maybe even if we want to put our own valuation on there, we can go through some of the financial statements and kind of look at that. But let's look at this over allotment option here for a second. So in the previous slide, we saw that one of the duties of the underwriter is to provide some sort of aftermarket stabilization. Okay, and this is really where the over allotment option comes in. So if we read this over allotment option, it says the selling shareholders have granted the underwriters an option exercisable in whole or part at any one time for up to a 30-day period after the closing to purchase additional shares from the selling shareholders. And that's usually almost all over allotment options are going to be approximately 15% of the shares that are being issued. So, you know, what is this over allotment? A lot of times we talk about over allotment. We refer to this, you know, as a slang, not a slang word, but a term as a Greenshoe option. And here, this is going to allow the underwriters to oversell this offering by up to 15%. And so what that does is that it actually can create a short position for the underwriters. And why is this short position important? Because potentially in an IPO, we may see that there's downward pressure in the price. And so that downward pressure might create some downward volatility in the price. And by setting up a short position in this over allotment opportunity, this allows the underwriter to post some stabilization bids for the price going forward. So if the share price was issued at $12 per share, and let's say the share price then had fallen back down to $10 per share, and remember, the underwriter has an obligation to provide some sort of aftermarket stabilization within this offering. They may go and then buy these shares at $10 in the market and be able to mitigate that downward pressure and close their short position, which would provide some sort of market base or stabilization within that period. Now, if the price doesn't fall below 12, or there doesn't need to be this downside protection at the offering price, let's say it goes from 12 all the way up to 15, and there's really no downward pressure, then the overallotment option will be utilized and exercised. And then all of a sudden, this overallotment option, either they're going to already sold 15%. Additionally, what on top of the authorized shares, and then all of a sudden there's no need to go and close out a short position. There's going to be an additional 15% sold within the market, and there's no stabilization there. So the overallotment option would have been utilized in that case. So that's what the overallotment option, commonly referred to as a Greenshoe option. And so I encourage you, as you go through some of the chapters and focused on primary issues and underwriting, to open up CDAR, go back and kind of look at different things and explore here on CDAR, right? So if you go back to the main page on CDAR, you can go in here and search the database. Once you search the database, you can click on company. Within there, it's going to be a simple search, right? So you can go through here, look up a company or a common IPO that you might have heard of in the recent past. You go on, you can look at not only the prospectus, but you can look at other different documents if you want. But if you go to the prospectus, you can kind of walk through the prospectus and kind of understand, the details of that prospectus. So that's kind of a walkthrough of the offerings, okay, within this seminar here, or this video. And if you like the video, as always, I suggest that you always like the page. You can leave comments if you want. I highly suggest that. And if you do have any comments or questions, leave them in the comment box below, and I'll try to get them as soon as possible. So thanks for watching, and have a good day.